Hey, Kevin here, top 1 financial advisor and best-selling author, and we are here to talk about the stock market. Today, I want to give you the top 10 traded ETFs of 2021. When I say that, I mean what were we buying? What were the average investors buying and selling in 2021? I'll give you the ticker symbols, I'll give you the current returns, so year to date, and then just very, very quick commentary. As you can see, I am back in my studio, and by studio, I mean a corner of the room. That's it. It's just a corner. Nothing special. At some point, I should probably get like a bookshelf and some things when I become a real YouTuber. But anyway, aside from all of that, let's go ahead and get into the list. Now, I got this list from the same place I got it yesterday, which was Business Insider. And at the bottom of the article, because I be reading things from head to toe, and when I read it, they just listed it there. They didn't really give a ranking like they did the stocks from 1 through 10. So I'm just going to list them the way that they listed them here. I'm also just going to give you the ticker symbol and the return and give you my thoughts on it, as opposed to the entire name of every single fund. Some of these can be a mouthful. So for example, it'll be the Invesco NASDAQ 100 triple leveraged ETF. Like that's a lot, but I will tell you whether it's leveraged or not, and we'll get into why that's important. All right, so the first one is SPY. That one is, the ticker symbol is, well, SPY. SPY, let me pronunciate correctly. That's the S&P 500. Obviously is one of the most popular because it's on the list, but also this is like your starter index fund. Everybody should have a version of this if you don't already. It's up 23.85%, and that's the bar. That's the bar. A lot of people ask me, well, is there a certain percentage where you decide you want to sell a stock or something like that? Well, yeah, usually I'll look at how did SPY do and how did another one of these ETFs do in that same time period. If I can beat this index, if I can beat this ETF, I'm probably going to keep it. If I can't, then there's a chance that I could let it go. The reason is, with SPY, it's the S&P 500, it's the largest 500 companies in the US. I'm automatically diversified. I take on less risk by having 500 companies compared to one. And if the 500 do better than the one, I pushed too many chips on one company. I put too much risk in one company. Why keep it? Right, when I can take on less risk and get more returns. Now, statistically and in real life, it is very, very, very hard, and most people would say unrealistic, to beat the S&P 500 on a consistent basis. More than 92% of professional institutional managers don't do this. So, that's why I invest in index funds. I don't have everything in index funds, but we're talking 70-80%, actually closer to 80% of all my money is in index funds. And the other stuff that I do, individual stocks and Bitcoin and stuff like that, that's what I'm trying to push it up and get a little bit more. So, and we talk about this. We talk about this all the time. Sometimes we're right, sometimes we're wrong. But that's the bar. I try, and the S&P 500 is not 23% every year, but that's my goal. I hit that or do better is what I'm trying to do. All right, that was a little long for that one, but we'll kind of breeze through the rest of these. The next one is QQQ. This is one of the more famous ones. I say famous because they have commercials. You don't really see a whole bunch of you don't see a whole bunch of commercials for ETFs unless you're watching Bloomberg Business or CNBC all day. But if you're watching something like ESPN or just another random channel, you can get commercials, or at least I get commercials, for the Invesco QQQ ETF. It invests in the NASDAQ 100, which is basically the top 100 tech companies. As of this year to date, they're up 23.85%. Now, I had to double check that, and that's for whatever reason this time. Well, it's not for whatever reason. I'll give you a reason here in a second. It's pretty much matching the S&P 500 this year. That's not always the case. Now, the reason, though, is because you have the S&P 500, the 500 largest companies, period, regardless of industry. The NASDAQ 100 is mostly tech companies. Well, when some of the largest companies, period, right? Apple's one of the largest companies by itself. So is Microsoft. Well, they're going to kind of overweight some of these, and you're going to have some duplication there. So that's basically what's happening. And right now, and this has been the case for quite a while, where tech, wherever tech goes, is whatever the entire stock market goes. So in this case, they're the exact same. Some people will tell you I just do QQQ because tech tends to do a little bit better. That's fine. If you don't want to do SPY, that's fine. I'm not going to fight you on it. The only problem is if tech doesn't do well, that's going to be an issue for you, whereas the S&P 500 has other companies to kind of balance that out. The other thing too, and I have not sat down and done this yet, but people are compiling their research and their data to put out predictions for 2022, or expectations rather, I think it's a better word, expectations for 2022. They think, and most people feel, that tech is not going to do that well because of the threat of rising interest rates. I don't know that yet. I will let you know when I finish my research and I form my own opinion, and that's what I will let y'all know. But if that were the case, then QQQ might not be the best place, if that were true. I don't know that yet. I can't tell the future. I have not completed my own research on it to form my own opinion. So I'm gonna just throw that out there. Also, SPY, you'll see in my public portfolio, I have that. The one reason I have is because when some people will sign up for free shares, as you can as well, you'll see that was one of the options. So I got it. So that's one of the reasons why I have it. All right, next is TQQQ. It's a play on QQQ, but this is a leverage ETF, and I have the notes here. It is 3 times the leverage of the NASDAQ 100. So it's actually up 71%, and I guess 23.85 times 3% gets you somewhere close to 71. Now, this is, you want to put an asterisk here because we've done a video on leverage ETFs. I would really encourage you to go and watch that. And what this is, it's a very specialty niche type of ETF that uses leverage. So when we say use leverage, they use options, they borrow money, and if you make 1% in the NASDAQ 100, 1% in the S&P 500, then you get 3 times the gain with an ETF like this. But it also works in the opposite direction. However, the other thing you want to realize too is that these are like one-day gains. It's not necessarily, something you should hold for an entire year. They'll tell you this on their website and actually give you a warning, and that kind of throws off the numbers because very rarely is anybody holding this. Listen, I'm supposed to update my computer. You're not really supposed to be holding this, for more than like a week or anything like that. And I think most websites will tell you like a day or two max. But also remember this: if the market falls, like it had been doing with the exception of today, then you also lose 3 times more. I don't want that. These are not things that I personally want. If you're a more risky investor, knock yourself out. But most people, you don't want to mess with these leveraged ETFs. But that's what it is. That's TQQQ. It is a leveraged version of the regular QQQ. All right. Next on the list is LQD. This is a corporate bond ETF. I'm sorry, I don't think I mentioned this either. ETF stands for Exchange Traded Fund. This is a collection of bonds or stocks put together. I've said it a bunch of times, but you might be new, so I want to make sure that you're in here with us and you understand these terms as well. All right, so this is a corporate bond ETF. It's not supposed to do incredibly well. So if the market is up 23%, you don't expect the bond to be up. In fact, this one's actually down 4%. Stocks and bonds are supposed to move in opposite directions. When the market is down, bonds do better. When the market is up, bonds don't do as good. They don't do as well. The reason is they kind of hedge against each other. Stocks are future looking. They're not guaranteed, where bonds are more guaranteed, where the company is supposed to pay you back a certain amount of money. That's an entire topic for another day. However, it's down 4%. It's one of the most traded ETFs on the market in 2021. All right, next one is TNA. This is another leveraged ETF, and I think this is a small bull 3x leveraged ETF based on the Russell 2000. I'm sorry, no, it's not based on the Russell 2000. It's based on 2000, the smallest company. So take small cap. So we're thinking, if McDonald's is really big, if Starbucks is really, really big, then we're talking like Wendy's. You got to go look for Wendy's. You don't have to look for McDonald's. Just throw it out there. Not saying which one is best. We can argue that a different day. But anyway, that one is a leveraged ETF. Not something I would do. But that one is up 20.5%. And again, anytime you're doing these leveraged ETFs, putting asterisks on the yearly gains, because the math gets a little weird there. But throwing it out there. Again, check out that leverage ETF video because I really go into it there. All right, next we have IWM. This is an emerging market ETF. Emerging markets, these are countries that are set to be the next big thing. At one point, and this was like 10 years ago when I started my Wall Street journey and did my internship, these were Brazil, India, China, countries like that. Well, China is here. Okay, India, I think they're on their way if they're not here already, depending on who you ask. So these are, again, not necessarily those countries specifically, but who's next up, which countries are really kind of breaking out and growing. This type of ETF invests in those places and owns companies in those places, which is a benefit to you because you may not be able to invest in, let's say, a Taiwanese company that's doing well. This ETF can. So it is only up 11% this year. There are benefits and disadvantages of investing in emerging markets. Sometimes it's a key area of growth and can really give you more diversification if you want to have your money in places outside of the US. Other times it can get more complex. Other times you can get a lower gain from it, right? Like right now, this year in 2021, you could have made 23% invest in the US only. If you had diversified a little bit or put more money into emerging markets or all of your money into emerging markets, you'd have made half of that at just 11%. Yes, 11% is still good. It's still good, but it ain't the 23. Okay, you could have doubled your money had you pushed everything into the US. So throwing it out there as well. All right, next you have, and that ticker symbol was IWM. The next one is TIP. This is TIP. This is Treasury Inflation Protected Bonds. This is an old school investment, but one that makes sense as popular. One that makes sense as to why it is popular today. It's up 0.36%. Not much at all. But the way this works is it is a bond that grows with inflation. And you throw inflation out there, that's where it starts to make sense. So for example, if you were to get, let's say, a bank account or a bond, say, look, I'm going to pay you 1% over the next 5 years. That's fine. But if inflation is going like it is this year, where it's up 5% or 3% or whatever it is, then my money is actually worth less in 5 years. It's worth less in a year like this. Right, if I had $100 in January, it is worth less today than what it was in January because the cost of everything, not everything, the cost of most things, the things that are important to me, gas, chicken wings, stuff like that, has cut in to what the $100 would have been. A Treasury inflation protected bond, or security is what they would say, actually balance it out. So they'll say you get paid whatever the $100 is worth. They are going to compensate for that. So $100 today will still be $100 10 years from now because it is inflation protected. That is how it works. So it's there. I mean, it's still a bond, so it's not something I would throw a whole bunch of money at and say inflation is high, I'm putting all my money here, because again, it's only up 0.36%. So not where I would put my fortune. But if you want to have some money that is protected to some degree, it can be something that you want to allocate. What some people do is if they have a cash allocation. So that means, let's say I have $100, I invested $95. I don't know what I'm gonna do with this $5 yet. So I'll put it in something like TIPS, TIP is the ticker symbol there, and it'll just sit there. It'll probably grow a little bit for me until I decide what I want to do with that extra $5 that I want to invest. So kind of like a parking lot, I would consider it like that. All right, next is SPXL. This is a leveraged ETF based on the S&P 500. Again, this is also 3 times the leverage. So market is up, you get 3 times the gain. Market is down, you get 3 times the loss. This one is up. Again, want to emphasize there's an asterisk there. Up 84%. So when I was looking at it, I was like, oh my god, 84%. Why am I not investing in something like this? Then I went red, find out what it was. I'm like, ooh, no, I probably don't want to do that. And the reason why the math is off, again, I've said it like twice already, but do go out and check out the leverage ETF video. The way they reset and recalibrate these ETFs every single day. So it's not the same investments that you got on January 1 and the same formula or recipe that it was on January 1. It's not the same ones you have today. Every day they kind of reshuffle the deck, put it right back to square one, and then start over. So the numbers that you see from January to now at 84% isn't the most accurate depiction of how the data would work. So again, be careful there, okay? Because otherwise, everybody would just be invested in that, right? So be careful there. All right, VTI is one I talk about all the time. Is the Vanguard Total Stock Market Index Fund. This one's up about 21% year to date. Now here's the thing. You might be sitting here and thinking, well, what's the difference between SPY, which is the S&P 500, or VTI, which is the total stock market? Remember, there are more than I think 9,000 is the last number I remember. There are thousands of stocks out there. S&P 500 is just the 500 largest, which is a decent, not the best, but it's a decent indicator of the entire stock market. But it's not the entire stock market. It's just the 500 largest. VTI is supposed to represent all the stocks. So because it's all the stocks and not just the top 500, or the biggest 500 rather, your performance is just a touch different, a touch off, if you will. And it is up 21.6% again compared to 21 or 23.85 as SPY. Which one do you choose? It's up to you. It really is. I have a total stock market index fund in my IRA, and that's just what I roll with. On public, I roll with the S&P 500 because it was free. That's really it. Not too complicated. I would not put them both in the same account. If I had a VTI or an ITOT ticker symbol there, I would have went for that if the option was available for me for a free share. I would have, but I wouldn't go and get both of them inside my IRA. That wouldn't make sense. You're duplicating, you're copying and doing almost the exact same thing. So throwing that out there as well. All right, we got one more. My computer locked me out. Okay, the last one is EMB, ticker symbol EMB. It is an emerging market bond ETF, which again, we talk about emerging markets. My pronunciation is all off today. It talks about the emerging markets and bonds in those particular places. This one's actually down 6.5%. This really goes back to two things. Number one, because the market is up, bonds aren't going to be the sexiest thing in the world. Also, compared to the regular bond index we had, that one was LQD. That one is down 4%, so you're taking a little bit more risk with the emerging markets, and that's common. The thought is, if you are a U.S. investor and you're investing outside of the U.S. for the most part, not all the time, for the most part, but especially in emerging markets, you are taking on a little bit more risk. Sometimes the fees are a bit more, but the returns should be a bit more. In this case, that's just not happening. So this is it. This is the top 10 most popular ETFs for retail investors. If you want to pick one or two of these that you want to really get into more and kind of do somewhat of a breakdown, kind of like we did with the infrastructure ETFs, feel free to let me know. I like to do like 2 or 3 to really help us dig into it. If I do 5, that's gonna be a lot harder to do. But let me know in the comments below. I gotta go back and check really the last 3 or 4 videos because I saw some good questions and comments there. I want to pull those up and try and do those this week as well. All right, that is it for me. But before you go, I got 3 things I need you to do right now. Hit the like button, hit the subscribe button. Come on now. All right, this is attendance. Like, subscribe button. Also, join our email list. I only send like 1 email a week. Really, you might get 3 emails a month. That's it. So it's not even 1 email a week. I do free classes. We talk about the book. We talk about other things that should be on your radar in case you missed a video. So you want to make sure you do that as well. That link will be here somewhere. We'll see if I can measure that correctly. It'll also be in the description below. And if you're on Facebook, it should be on the description above. All right. That's it for me. I'll talk to you guys later. Bye.